Hello YouTube. In today's video, we'll be looking at the financial strategy of dollar cost averaging. Now, I'm not a financial advisor, so it goes without saying that this is not financial advice. We'll just be looking at my take on dollar cost averaging and what are some of the pros and cons of the strategy. Now, it's a concept that's pretty simple but can be powerful depending on who you are as an investor. My name is Abhi. This is Credit Debit with Abhi, and like we do in all of our videos, without further ado, let's dive in. Let's start by answering the question, what is dollar cost averaging? It is the concept of buying the same dollar value of an entity over a regular interval of time without necessarily paying a lot of attention to what the price may be at these intervals. It's a term that's generally associated either in the stock market, ETFs, mutual funds, and we'll take a look at a few examples later on in the video that will help explain what this means. But to begin with, let's understand who dollar cost averaging is meant for. If you're a low risk investor, or you're starting your investment journey, or you're someone who does not like to put in a lot of research into the stock market and understand what businesses are doing, this might be a good strategy for you. This is also a good strategy, especially when prices can be volatile. When there is a stock or an entity that can fluctuate a lot in pricing, that's where dollar cost averaging can actually even out the spread of the pricing and give you more stable returns over a long period of time. Now, there's no definition to what long period of time technically means, but generally speaking, you should be looking at anywhere between the 2 to 5 year horizon when thinking about long-term horizon. That's not to say that you cannot gain returns in a shorter period of time, but you actually get to see the value of dollar cost averaging over the longer run. Now let's look at the inverse of that. So who is this not good for? Now, if you are someone who has higher risk tolerance, who does not mind doing a lot of research on markets in general, and if you are a savvy investor who understands the stock market really well, now I would argue a lot of people who say they understand the stock market actually don't. But having said that, if you do understand the stock market really well, you can actually allocate lump sum money to specific stocks or ETFs and mutual funds or even cryptocurrency and make incremental returns from that. The other thing I'd also note is that if you're dealing with an entity that's fairly stable in terms of its pricing and the increases are more gradual, so think about the S&P 500 stock, and we'll use this as an example later on in the video like I mentioned earlier. Those stock portfolios don't generally yield very high returns when you dollar cost average against them. Now, that's not to say that you still can't get good returns. It's just to say that the returns are going to be lower than other units that have a lot more fluctuation. Now, we'll dive into a couple of examples. So we'll take two different entities. One is the Apple stock over a 5-year time horizon. The second unit is the SPY ETF, which is the S&P 500 ETF. Now, by definition, since it houses 500 different kinds of stock, it has inherent hedging built into it. And therefore, the pricing on the SPY is more stable than a stock like Apple. Now, one can argue that Apple as a stock has just had outsized returns, and that's true. So you can do this analysis across any other stock. And if that's something that is of interest to you, let me know in the comments below and make a video doing this analysis on a couple of other stocks. We'll also use some of our future videos in doing other investment strategies and talking about them in a little more detail. But for the time being, let's dive into those two examples. So let's start our analysis with the Apple stock. So as you can see, I'm looking at the most recent price of Apple at the end of April. And if you're investing $100 on a specific day in the week, how many units we are buying as a result of that. I've taken 5 years worth of data, as you can see, and we are assuming that the buying is happening on a specific day in the week. So if we do the math here, as you can see, towards the beginning of the buying cycle, we are able to buy more stocks for the same $100 because the price is lower. And as we move towards the current dates, the price has gotten higher, and so you're buying lesser stocks. Now, if we do a holistic analysis of the 5 years of buying, so we are assuming the buying started in 2018 and went all the way through to April of 2023, we'll see that the total stocks we bought is about 305. The total holding price is basically the current price multiplied by the number of stocks we bought, so that's about $50,000, and the total investment is $100 multiplied by the number of days we bought, and that happens to be about 252 days, so that's $25,200. Now, if you look at the absolute growth over the 5-year period, that's about 98%, and the compounded annual growth rate, which is a great indication of how much your portfolio or how much the stock has grown every single year. So if the stock grew 14% on the base price every single year, we'd get to about 97% growth or 98% growth in 5 years. This is a very healthy number given where inflation is at. Even with the high inflations now, which is closer to 6, 7, 8%, this is still higher than that. But consider the US economy's inflation before that, which was generally around the 2% mark. So this is 7 times that value. Again, this is the power of dollar cost averaging. This is an S&P 500 ETF. So I wanted to take an example of an ETF and show what dollar cost averaging for that would look like. Similar to the previous example, we're assuming we're buying $100 worth of ETF units every 7 days, as you can see. So on the timeline, you'll see all these dates. And then on the same day, we are buying $100 worth of units, and that changes over time based on the price of the ETF unit. Now, there hasn't been as much fluctuation in the price of the ETF unit as there has been in the case of the Apple stock. Since the S&P 500 is a pool of different stocks, that averages out how much price fluctuation we can see. So this is a good ETF to buy into if your risk tolerance is low. Now, if you do the math on this whole thing, we see that the total units that we have bought over the 5-year period, investing $100 every single week, is about 74, and the holding price per the current price in the market is about $30,000, and the investment is the same as the previous time, $25,200, so $100 for over 252 weeks. That computes to an absolute growth of about 19%, and the compounded annual growth rate is about 3.5%. Now again, this might look low, but historically, if you ignore the last 1 year, the inflation, like I said, has been around 2%. So this is about 1.5 percentage points more than the 2% inflation rates we've seen. So if you'd bought this ETF every single week, you'd be growing the value of those ETFs that you have accumulated at the end of the year by about 3.5% every single year, computing to about 19% over the course of 5 years. The last thing I'll also mention about these examples is the concept of brokerage fee. In simple terms, what it means is every time you buy a unit, the platform might charge you a small fee to allow you to trade on their platform. Now, in the second example with the SPY, if you looked at the 5-year compounded annual growth rate, it was about 3.5%. Let's say the brokerage fee on the platform that you're using is 0.5%. Now, in that case, the compounded annual growth rate actually comes down from 3.5% minus the 0.5% that you're paying on brokerage down to 3%. So it does have an impact on your growth rates. The other thing you need to also account for is inflation. Now, if the average inflation rate was about 2 or 2.5%, you need to subtract that from the growth that you're seeing in your portfolio or in your unit, and that will be the net growth that you're having on the unit. So again, if we use the example of the SPY ETF and use 0.5% as the brokerage fee and 2% as the inflation rate, our compounded annual growth rate comes down from 3.5% to now about 1%. I'm hoping that video was helpful to explain the concept. Let me know what you thought of the video. If this was helpful, hit that like button. If this is the second time watching a video, consider subscribing. And like always, I'll see you in the next one. Peace.